In this video, I'll walk you through step by step exactly how we were able to spot, identify, and execute this position. And you can do it consistently and repeatedly. It's completely mechanical, completely rule-based, and it has a step-by-step mechanism to it. And also, if you stay to the end of the video, you'll be overwhelmingly surprised that we have a very, very valuable free gift, no strings attached, ready for you at the end of this video. Please, guys, enjoy. I'm going to walk you through step by step how it is that we're able to consistently pull out entry models and trades, just like the one you're seeing being played out here. From start to finish, from structure to liquidity to supply and demand, how to pick your targets, how to exit the trade, everything step by step you will learn today here in this video. So ultimately, before we actually get into a trade, we first have to understand a couple of things. These are the pillar frameworks to building a consistently profitable system foundation. So step number one, and the most important pillar, is of course market structure. Market structure is ultimately our blueprint. It's what we use to understand the order flow, the footprint that the bigger guys that are actually operate in this market are leaving behind. So with that said, let's dive in and understand our order flow footprint. Now, there are multiple layers to this, so I want to kind of start with the theory behind it. Now, simple market structure and one-dimensional market structure looks, of course, something like this. You see we have essentially higher highs, higher lows, higher highs, higher lows. Now, what that does, it delivers us our footprint. And the ideology behind this is we want to be buying the higher low, and then we want to be selling the higher high. So by understanding where price has come from and where it is likely heading, that is our edge. That is the discretion between where price is right now to where it is going. So again, as this is the example, break of structure, we're anticipating a pullback and then a higher high. Our job is to get involved here. We want to buy the higher lows and sell the higher high. And that's exactly what it is that we're going to do in a moment. But to understand this even one layer deeper, we're going to have to take a look and dive into multi-time frame structure, which is likely going to look something along the lines of this. So you need two different time frames. So for the purpose of this, we'll label this right here in red as our higher time frame, which is completely subjective. Ultimately, it could be any time frame that is higher than another one. And we'll just plot in this as our lower time frame. So that right there represents our lower time frame, and we'll color code it with a different color. For the purpose of this, let's go and color it in black. And then we'll map those out in green, so our structural points. Now, essentially what you will see is on any one price leg, if you drop down to a lower time frame, there will be many price legs within that leg. It's ultimately called fractals, right? It's just multiple time frame analysis of market structure. What you'll notice is in alignment with the higher time frame, you'll see this ebb and flow between bullish and bearish price action on a lower time frame. So as you can see now, as the higher time frame leg goes for a continuation, we see the internal lower time frame aligning with it, putting in a series of higher highs. Now, you'll notice that when the higher time frame finally puts in its high before it begins to put in its higher low, you can see we have this market structure shift right here, this change of character on the lower time frame. That change of character is indicative of lower prices on the higher time frame. Essentially, look at the lower time frame as a insight into the higher time frame before it's happened, a lagging indicator, if you would. So when we have this change of character to the downside, we have a lower low, lower high, and lower low, continued bearish price action once this. So this occurs, and we then assume that we're going to see essentially lower prices. Lower prices come. And then at some point, the internal lower time frames goes from bearish to bullish, right? This is called realignment. What happens is the lower time frame realigns itself with the higher time frame. When this occurs right here, we now know that the likelihood is that this high up here on the M15 is being taken out. And so that is how we buy the higher low and sell the higher high. Now let's walk through a working model of that in the market. So when we actually come to, of course, pillar number 1, which is market structure, of course, we need to understand where it is that we've come from. Applying our mechanical foundation of our 3-candle consecutive pullback, essentially we can see that we came from high, higher low, higher high. Essentially, price did come back and put in a higher low, failure to put in a higher high. Instantly tells us that there weren't enough buyers to take price above this high right here. And then ultimately, off the back of that, we pull back and then we have this sharp abruption to the downside, causing what? Our time frame change of character, a higher time frame change of character, the downside. This is essentially when the higher time frame shifts from bullish price action that you've been seeing to bearish price action. And ultimately from there, the lower low is ultimately here. So now we have a trading range. So you always want to be operating inside of a trading range. We have an M15 swing high, and we now have our M15 swing low. That right there is ultimately our trading range. Anything inside of this is just part of the internal range. So after we get the abruption to the downside, essentially we have our pullback. Now, after we have this area pullback, you can see that we end up breaking structure again to the downside. So this M15 swing low gets broken as expected. We have a break of structure. Well, now what happens is we have a new trading range. We have a 15-minute strong high, M15 swing high to our M15 swing low. So everything inside of this price leg right here is ultimately just internal, right? So if we just pull this box in here, up here, all of the price action that you see inside of here is essentially just a pullback. So the idea behind this is that we've just put in a lower low. So number 1, we know that our order flow is bearish. Now we only want to be trading in alignment with that bearish order flow. So we need to wait for a couple of things. Number 1, we need to wait for a pullback back into premium pricing. Essentially, premium and discount pricing is a concept of expensive and cheap, right? It's very theoretical. But more oftentimes than not, price will pull back to at least the 50% region of a price leg. So using that statistical knowledge, we can understand that we want to wait for price to become inside of our pricing leg to give us the highest probability of getting into a successful trade. And once we have essentially this theory outlined, then what we want to go ahead and do is have areas of supply and demand that we can use to potentially look at where there are clunked orders sat in the market. And it's essentially our hope that price will mitigate those orders, and there will be an overwhelming load of, in this case, sell orders for the buy orders that come and tag that price in. Upon that, essentially, we just place our orders where we think that the majority of the orders are, as long as it is below this M15 swing high that plays in line with our structural bias. We essentially are hoping that if we get an entry confirmation that we can take price down to this M15 swing low down here. Logically speaking, all we're actually doing is understanding that price is bearish. We understand that we have our premium and discount tool, so we're waiting for a pullback. And again, it's the same thing. In the scenario that I give you at first with structure, it was a bullish scenario, but if we went for a bearish scenario, ultimately, we are selling the lower high. We're selling the lower high and we are exiting at the lower low. So we want to be selling the lower high. So we're assuming that this lower high is going to be somewhere around this region, or in fact, at this point, anywhere above this high is going to be the lower high. It could have been this, it could have been any of these levels, but we need the confirmation to go with it. So we want to be selling this and targeting this. And in order to do so, essentially, this is the exact scenario we have right now. We have this break of structure that we've just had. And then ultimately, as price pulls back, right, like what this is in here, this is a pullback. As price pulls back, that price delivery on a lower time frame is going to likely be bullish. Now, what we want to do is map out a few areas of supply that we potentially could see a reaction from. And in that area right there, in the area of supply, we need to see an internal realignment. So what you'll notice is in this theoretical example, price is making these higher highs, higher lows, higher highs, and higher lows. We get into this level, but we fail to take out the low. We push up higher. We get into the level, but we fail to take out the low, and then ultimately we break through it. What we need to see ultimately is this, is a move into an area where we think there are orders that align with the institutional order flow, and then we need to see a lower time frame alignment. And this ultimately is going to be our first sign of displacement. That ultimately tells us that there is an overload of supply versus demand, thus price will decrease. There is more supply than there is demand. There are more sellers than there are buyers, ultimately. Not necessarily in terms of how many sellers and how many buyers, it's always about the quantity of units. So it's ultimately, there are more orders, there are more lots of cells in this region than there are buyers, thus pushing price down. And that is how we read the order flow footprint through candlesticks. Ultimately, we're just reading the order flow footprint through candlesticks. So once we see this right here, this alignment, then we want to look to get involved. That is our sign that this is now the higher low, the lower high, sorry. This right now is confirmed as the lower high. So when we get that, which we'll walk through in just a moment, that is our confirmation. And we want to be selling this area if we get this confirmation. And where do we want to be targeting? We want to be targeting this area down here because this is the most probable and realistic target that we can be looking for. Now, in some scenarios, that will be a 1 to 5. That will be a 1 to 7. That will be a 1 to 12. In some scenarios, it's a lot higher. In this scenario, it's a 1 to 29.25. And 15 swing low. So the R multiple varies, but ultimately the system and the step-by-step methodical approach remains the same. So here we are back on the actual price charts itself. Now we need to understand a few areas of where supply may kick into the market. So supply area number 1, we can see is here. Supply area number 2, we can see is in here. A large portion of that has been mitigated, but nonetheless, it's still in there. And then supply area number 3 is in here, up to the wick up in here. That is our supply area number 3. And ultimately, just understanding supply and demand, it's typically just 4 phases. You have essentially a range, an initiation, a mitigation, and a continuation, right? Or the other variation of that is you have a range, a liquidation, initiation, mitigation, continuation, right? So it will always start with some sort of range followed by large momentum that comes out of that. And of course, you can have multiple in one price leg. Price can go, for example, range, initiate, range, initiate, range, initiate, and all of a sudden now you have 3 points of interest in one structural leg. So all we're doing is understanding that in between these areas, right, there are ranges on this time frame or a lower time frame. These ranges represent usually large quantities of units exchanged at a fair price before one dominant side of the market takes place. Price usually realigns itself, and at these levels, we understand there to be a large amount of orders still resting in those areas for various different reasons. And so ultimately, we're betting on the idea that when we get into these areas, there are still orders waiting to be executed. Aligning that with the obviously structure, because it has to be in alignment with the institutional order flow. Otherwise, you can just look at any range and think that any range will hold, and that's not how it works. The foundation, the bedrock of the system is, of course, market structure. Then once we get back into these areas, it's ultimately looking for our confirmation. So step number 1 is identify your bias. Have your institutional order flow mapped out. And in this scenario, you can see that price essentially is bearish. Our institutional order flow is bearish. You want to make sure that you're selling in the premium. If you are selling, we've ticked that off. You want to then map out your areas of supply and demand, ultimately expecting there to be pending orders in there. We've ticked that off of these 3 zones right here. This one is more so mitigated than this one. So, you know, we'll keep it on there as an option, but, well, you can kind of see that it gets disregarded anyway. And then we come into the larger range that initiated the move to the downside. So we've ticked that off as well. Now you can move to your entry model. Now the entry model is fairly simple. It's exactly what we just looked at. It is essentially understanding that if the higher time frame is bearish, the lower time frame comes back up bullish, and then we want to wait for a realignment of that order flow. Ultimately, this confirms to you that the price has found its lower high. And then from there, get involved on the mitigation and get out at the lows down here. That is the exact model. So with that said, how does this play out? Well, once you get into these zones, what you can typically do is go down to a lower time frame, i.e. the 1 minute time frame, if that's the time frame of your choosing for your lower time frame structure. So once you get down in the 1 minute time frame, you of course need to map out your order flow on the 1 minute time frame to understand how exactly it is that you're going to be getting into this position. So we'll start with this. Essentially, we have a high, higher low, higher high, higher low, higher high. And then what we see in here is a change of character. So this change of character occurs in here. And funnily enough, that is a time to get involved for an entry. So what we would do is move up to the 3 minute time frame. I prefer the 3 minute if it's available. Move up to the 3 minute time frame to identify an area of supply that could have caused a change of character. In this scenario, we have this area of supply in here. And this right here would be a short position. So we'd go short from this area of supply right here. I like to take, that's a long position. We go short in this area in here. 2 pip stop loss. I personally like to take partial profits at 5 risk to reward, and then let the rest run for the full target. So we'd go 5R, and then of course all the way down to this target here. And again, yes, it looks amazing, 46 risk to reward, but don't get too consumed up with these. A lot of the bigger trades usually run 5R, come back for a break even and things of that nature. However, a portion of them, of course, do run to their full duration. That's why we only leave a portion of the trade open. So back to the 1 minute time frame. So this would have been our first position. And then from here, what you see is that price puts in a lower low. From there, it pulls back, lower high, and then lower low again. So the moment this gets broken structure, well, essentially we are bearish. So if we come and leave this order on here, what we're essentially doing, which doesn't make any sense, is in order for this trade to get triggered, this high would have to be taken. And in order of our philosophy of understanding structure, then to tag us in on our short position, price would have to become bullish. So it makes no sense. So at that point, you would remove your order and you would look for a different position from this high. So again, you can go back up to your 3 minute time frame and look for a position again. Now, in this particular scenario, there is no area of supply. So there is no area of supply to take an entry. So what I would be particularly waiting for is some sort of pullback, a mitigation of something, continuation, and hoping that the continuation would leave me an order block. And that order block I'll be able to take an entry from. So fortunately, or fortunately, there was no execution being able to had in that specific scenario. And then we change character. Now this is again something that you will likely see a lot of the times, is when price comes into your zone. Let me just remove this so you can see very clearly. This gray box represents our higher time frame area of supply. When you come into these zones, it isn't uncommon that you may tap in, have a change of character, and then look to go short, and then get stopped out, and then price goes deeper into the level, and then you get the change of character again, and then maybe this one becomes a success. That's not uncommon. So don't worry, this is not a perfect system that's absolutely right all of the time. That's not something that I'm trying to portray to you. I'm just giving you the realities of the system step by step. So we change character back to the upside. Now indeed we are bullish. So we have no reason to be looking at execute in a short position because we are bullish. So ultimately we are looking at this as our M1 low and this as our M1 high. Now, as long as we sit inside of this gray box, we are waiting for an M1 low to be broken so we can get into a trade. So for now, I'll remove this and I will show you. So from here, essentially just playing the price out on the M1, you can see that very aggressively we change character. Change your character to the downside, very aggressively, may I say. And that is a clear indication. Just think about it logically, right? Just think about what this market is logically. It's simply just a transactions between buyers and sellers. And if there are more quantities of supply available than there is a demand for it, then price will decrease to go and gravitate toward where the liquidity is, where the demand is for the units of currency. That's just how the market mechanics work. So when you see this, an overload of supply enters the market, well, of course, that's very clearly aligned itself with our 15-minute, right? So now we've ticked all the boxes. Now we've had our whole higher time frame, we've come to our lower time frame, and now again, we have a change of character. But we need to get involved in the market. So again, first step, I will usually go to the 3-minute time frame. At the 3-minute time frame, I will try to find a point of interest. Now, what we can see is ultimately this area of supply has been mitigated. If we come up in here, we can see that this area of supply has been mitigated, but barely. And then this area of supply has not been mitigated. So there are a few different areas in here that haven't been mitigated. And what I would do is take the high, take the low of the whole range, right? The essential, or the entire range that the final buy to sell. This is the range that we're talking about, and this is the initiation. So we just want to take the last area of that range. Again, depends on the pip size. It typically varies from trade to trade. Maybe there'll be times where you only take this candle right here if it's a large candle. In this case, which I'll show you in a moment, taking the whole range just makes sense because of how small the range is in regards to pips. So that whole range is only 2.5 pips. So we've narrowed our entry down to 2.5 pips. What I would like to do is put our position at 3.5, cover the highs, just to be, cautious. Cover the highs where you can, if possible. We're looking at getting involved in here. And yeah, ultimately, I always want to take my initial profits at 5R. So I'll take up a decent portion of my position at 5R. That's my main bread and butter. And then I'll let the remainder run with a small amount, 20, 30% of the volume remaining down at the M15 lows. And the reason for that, and the reason I don't take the whole position, there's a multitude of reasons. Of course, number one is that, a lot of the times you run 5R, for example, and maybe you'll come back for a break even and then go again, right? And that's not something we want. We want to lock in our 5R. That's our bread and butter. That's what pays us on a consistent basis. And these extra big RRs are the occasional wins that pay us a little bit more. So that's one thing. Another thing is you don't always get in at the absolute high of the leg, right? There will be times where price will come in, move down, push up, move down, and then all of a sudden you zoom out and you realize you are in the middle of the price leg, right? So and then you essentially push up, push down. And so maybe you're getting involved in this trade right here. And actually price ends up doing something like this, right? And collecting more orders and moving down to the downside. So there are many reasons, especially this is one of the biggest one, is getting involved in the middle of the price leg decreases the probability that you will ride the whole trade out. Just obviously for the simple reasons just shown. So always looking at taking 5R, no matter where you're on the price leg, lock in your profits, actually pay yourself for your competence, and then look at taking additional profits, letting the rest of the position run with stops at break even. So that is essentially the idea behind the system. And then ultimately price comes in, taps in, and then the trade is ultimately the trade. Price sits around there for a little while. Price ranges around. Essentially, again, this in of itself is just the same thing again, right? It's range, initiation, mitigation, continuation. This is no different. It's just a range and initiation, right? The mitigation doesn't need to take place straight away. It can take place at a later date. It can take place right now. And so there is our first target hit. And upon this low being taken out is your break-even point. That is your trade management. And then you can leave a portion of your position. You can leave a portion of your position if you would like to run to this low. I always recommend leaving it because that's what the whole trade idea is based on anyway. And like I said, a lot of the times it won't be such a large trade. A lot of the times it may be a 7-hour trade, a 9-hour trade, a 10-hour trade. And in those smaller ranges, you'll typically leave the full position on to the low. But when it's such a large trading range, always better to lock in your profits. And so just playing out in the 4-hour just to make sure. And again, there is that range, initiation, price come all the way back up to those levels to mitigate that range, right? We had the range, the initiation, range, initiation, mitigation. And likely within those, you have fractals on fractals on fractals. So just waiting for the end result of the position. You can see price sits around in the entire range. And also psychologically, like imagine sitting in this trade, watching it run 20 risk to reward to come all the way back up, and you think you're going to get tugged out of break even. You haven't taken any of your position off. Trust me, you are not a real trader if you can sit there and tell me that wouldn't affect you psychologically because you have a plan in place. That's not how trading works. You are not a robot. You are a human. And that's how price plays out. And that's where we are up until today. With that being said, check out the link below. There is a free SMC course, completely free, no strings attached. I will give you everything for free. I don't want anything in return. Enjoy it and let me know how you find it. Ciao.